Look at your screens right now. Everything is bleeding red. Gold is down, silver is tanking, copper and platinum are dropping right alongside Bitcoin and Ethereum. If you think this means inflation is dead or the macro thesis has changed, you are missing the entire story. This is phase one of a classic global liquidity crash. It feels like a contradiction. Yesterday, we watched the US 30-year bond blast through 5.06% and the Japan 30-year spike over 4%. In a structural debt crisis, gold and silver should go up. So why are they dropping? Because when the bond market fractures this fast, highly leveraged hedge funds and regional banks face immediate catastrophic margin calls. To survive the afternoon, they need raw US dollars. They can take that money and instantly retire maturing short-term T-bills as they roll over. They wipe out a massive chunk of debt pressure without needing to flood an already exhausted private bond market with new supply, and without forcing Kevin Warsh to lower interest rates or print new money prematurely. At the same time, because the Bank of Japan's currency intervention completely failed, the US dollar index is moving vertically. A hyper-strong dollar acts like a wrecking ball to global commodities and risk assets alike. This isn't a loss of fundamental conviction. It's a forced institutional dash for cash. Remember the rule of a liquidity squeeze. In a panic, all correlations go to one. Every major macro bottom, 2008-2020, started exactly like this. Gold drops with the ship first, before skyrocketing once the system backs up completely. The market isn't broken. It's just out of cash. 7 days until CPI. Keep your emotions out of the charts, hold your dry powder, and watch that 5.25% warning level on the 30-year. Subscribe to stay ahead of the plumbing. Hit subscribe and I'll see you in the next one.